Hello, thanks for tuning into this episode. Before we start, FinTech Focus TV is brought to you by Harrington Starr, global leaders in financial technology recruitment. Head to the Harrington Starr website and check the links below so you can download the latest copy of the Financial Technologist magazine. And also, we've got the TradFi and DeFi Era of Convergence documentary coming up. If you're interested in the merger of the two, please get in touch. Thanks a lot and enjoy the show. Hello and welcome to another episode of FinTech Focus TV with me, Toby Babb. Today I am delighted to welcome into the studio Rupak from Galytix. How you doing?
Hi Toby, nice to meet you.
Listen, great to have you in here today. Loved hearing about the business when we met a couple of weeks ago. Yeah. Sounds like exciting times. So we're going to get into loads of different things about what you're doing at the moment. We're going to talk a little bit about this as well, which I know you're hotly on the case of at the moment. So there's going to be some really interesting stuff to talk about early mornings and so much more as well.
Yeah.
But before we get into all of that, you've got a good background on you. Tell us a little bit about it.
Sure. A couple of years on me, is that what you meant? Been around the block a bit. 20 years in financial services, all in London. I joined Credit Suisse. It was First Boston, as it was known, in the late 90s. Started on the trading floor when it was all prop risk and it was all shouting prices down the phone. And really saw that business change. You know, we went from 300 guys on a trading floor shouting prices down the phone to all electronic trading and quants and software engineers and the whole 9 yards.
That was proper change, wasn't it?
Proper change. Equity research was my job function for about 12, 13 years, covering bank stocks and financial intermediaries and stocks like ICAP, for example, and exchanges. Saw that industry change massively. I remember when I started equity research in the late 90s, you were scrambling for information. You were providing asset managers information that they didn't know. But, now with the internet and all sorts of other places you can get information is much more homogenous or out there. So I sort of saw electronic trading change, particularly the equity space where I grew up, which obviously migrated, as you know, first. Equities went first, or cash equities, then FX, and then we see it in the fixed income markets. But I saw that, saw equity research change. And one of the stocks I used to cover was a company called ICAP. And in 2004, a gentleman called Mr. Spencer came to my office, and he just bought BrokerTech. Got to know him very well over almost a decade. Followed all the exchange sector, the consolidation, the M&A. It was it was a small segment of the market, but it was very active. Remember, there was exchange consolidation around NYSE, Deutsche Börse, and these exchanges groups grew over time. It was a very, very active space, although it was a smaller segment of my coverage universe. And then in 2012, I sort of moved across the fence and joined ICAP, having seen that migration where, ICAP and Michael was a visionary and seeing the move to electronic trading. When I first looked at ICAP 2003, they just bought BrokerTech. Virtually all their profits were voice broking. They bought BrokerTech, they bought EBS, they integrated them, they expanded the product universe, then they did a bunch of post-trade transactions, Triana.
Sort of golden era at that sort of stage.
Exactly. Many of the alumni who are out there, created great businesses since then.
Previous stars of the show.
Previous stars, Mr. Beeston obviously ran our post-trade business. Gil Mendelsis, who's a Capitalist now, who's the Triana founder. And it was a great place to work because sort of Michael being a founder himself, brought other founders on board.
I'm really interested in those sort of incubators because it sort of breeds that entrepreneurial spirit, and there's certain companies and people down the year who've created those sort of environments, and it definitely seems that was a sort of hotbed at that sort of time. Right?
Yeah, I mean, I think it's always a debate about the founder CEO versus the sort of structured the CEO who's not a founder. But when you're a founder, you're completely aligned with your shareholders. You don't need to hire McKinsey's to make it look good for the board. You're completely aligned with shareholders. You live and breathe it. ICAP had grown very successfully and organically doing that. And if you think about it, I think I did analysis when we left the firm, but shareholder return had been thousands of percentages. Because most of it had been organic and very little add and acquisition. And the acquisitions had grown. BrokerTech, when we sold it, we sold the electronic assets for almost $6 billion to CME Group. That was BrokerTech, EBS, Triana, Trioptima. So, really saw that change. But also I was there from 2012 till 2-3 years ago, and we obviously saw a lot of transformation as well. The industry was changing, and what you learn is actually you need to be well ahead of the game. So, those visionary deals that Michael did in 2003 came up, benefited us later. So I remember we bought a stake in Optima well before I was involved in the company. Mark Yallop, who I worked with at the FMSB, and Michael were involved in that. And that was, sort of mid-2000s. Yeah. And I remember, looking at that time and thinking, what is this compression? Yeah. Reducing balance sheets of banks, why do you care? Just add more swaps onto your balance sheet. And that was actually one of the most valuable assets. And, some of these assets, they'll grow nicely, but then regulation kicks in. Optima, for example, the real kicker was the Basel III and the post-Dodd-Frank regulation where you had to shrink swaps books.
There's those moments, aren't there?
I think, our head of voice broking, global broking, David Carson, used to always have the saying, well, it's like a sock drawer. You put the socks in the drawer, that's your swaps. Yeah. And then he was actually instrumental to the acquisition as well. And they had the vision that actually 5 years later this was a nice business and it would grow. Yeah. But 5 years later there was a market structure change.
And do you think they foresaw that? Was it genius or was it just?
I think it's always a combination. We used to have this discussion in the ICAP management team meetings about genius or luck. And it's the honest answer is, and you and I have been around a long time. It's always somewhere in between. Yeah. Some will work, some will not, and particularly when you're a founder or you're near that, when it works, everyone's a genius. And what do they say? Failure has many parents. Yeah, sorry, success has many parents. Success has many parents, whereas failure is an orphan. Those weren't the only ones we threw out there. There were many things that we tried and then they didn't succeed necessarily. Yeah. And for a variety of reasons. It could have been it was a good idea, but we were too early. Yeah. It could have been that it was a good idea, but we couldn't execute because we didn't have the connectivity. For example, expanding the buy side is something we talked about all the time. Yeah. And we did have some degree of success, but to have massive success, you need to have that connectivity. And I always go back to companies like Market Access. Yeah. I remember before the financial crisis, ICAP was cool. And the IDB market was cool and the interbank market was cool, or at least even a couple of years after the financial crisis. And, the B2C platforms were, who cares about that? Mm-hmm. Bank to customer, bank to buy side. And, the same CEO of Market Access runs it today that ran it before the financial crisis, but the growth increased massively. Yeah. I mean, they obviously have done a fantastic job, many of these bank to customer platforms that, you know well, the Market Access, the TradeWebs, the FX Alls of the world. But, there's a variety of drivers, and it's typically regulation and technology. Yeah. And there's a lag effect. And I remember when I joined ICAP 2012 talking about Basel III, and it didn't have an impact straight away. It had a drip effect over 3 years. Yeah. Similar effect if you think about the foreign exchange market and internalization. Yeah. The internalization has been going around since 2006, but it really, it started hitting that curve around 2010, 2012. Yeah. Yeah. So there's always I think a lead time. Same with corporate bond electronic trading, which is a market that you know very well. Yeah. It was around before the financial crisis. It just, the drivers kick in around technology and regulation. And it's always a mix of, because you can have the technology, but there's no need for
areas that sort of just put gasoline on the bonfire at the right time, don't they?
Exactly.
That we saw another massive. You mentioned the financial crisis, but we saw another massive speeder of everything during 2020 in the industry, and the industry really adopted to it, and we saw massive revolution and adoption of different things, and happening in the marketplace. So carry on with the story. We diversified.
Just forgot where I was in the story. So we, my experience at ICAP was probably tougher than the prior decade, just because the industry wasn't growing as well. Regulation and so forth, but it was a fantastic experience. I got to work very closely with the board and the non-exec directors, which Michael was kind enough to allow me to do. Work with the rest of the management team, and really, my job was to be the blind spot person, which may be popular sometimes, may be very unpopular at other times, but that's the role they asked me to play, and we had some healthy internal debates. And it was a tough time. The market was changing. Prop trading ended. We had Dodd-Frank, we had Basel III. The market was going from IDB interbank market focus, because I always just define it as interbank rather than broader than just banks, because it's also HFTs, the Citadels and so forth of the world. But that industry was changing as well. But it was moving to a bank to customer market, and it was evolving. So organic was slowing, and on the other side, M&A was tougher. I remember when Michael did Broker Tech in 2003, coming up, or 2002. That was a deal he negotiated with the banks. EBS was an asset we bought from the banks. But when, in my time period, I remember the pitch decks used to come in, or the decks used to come in for the bankers, and it was all like 40 times EBITDA multiples. And valuations had just skyrocketed.
Good times.
Because the competitors had just got bigger. The exchange groups were $60, $70 million giants that could, step in using balance sheet to acquire stuff very, very cheaply. And on the other side, you had, financial buyers. So you had strategic buyers that were bigger and bigger and meaner than ever before to compete with. And then you got financial buyers, the private equity guys had worked out FinTech's cool. On the more mature assets. And on the early stage assets, the VC market had kicked off.
It was when it was. You're right. FinTech's cool was probably that sort of time, wasn't it, where it was adopting.
It made my job looking at M&A deals really difficult because you've got an exchange group that can pay. That's got a $60 billion market cap. They can pay big valuations if they really want it. They can take cost synergies out of the gate. Or you got a financial buyer, whether it's private equity at a sort of more mature level or a VC that can go in at a different kind of valuation. And they can sit there and, VCs, as they don't need everything to work. And they can look at a very large addressable market and take a view. Whereas we had to always go back to shareholders and explain that every quarter, every 6 months. It's the challenge of a public company versus a private company. Lucky enough, to have someone like Michael at the helm who was willing to invest, and wasn't looking at just quarterly stuff. But we always had shareholders in the background. It was like, well, what's your profit? What's your return on investment on that project?
He did a decent job at managing those at the same time.
He did, and I think timing is everything, and the electronic and the sort of the more digital assets, I would say, the electronic and post-trade assets. They wouldn't exist without the voice business. The voice business, the cash flow that it created, and the market share. ICAP was the number one voice broker in the market. Pure voice and hybrid. The swaps desk was world famous, and the profitability of it, and the flow that came off the back of that, and that generated those acquisitions. So but there was a time where they had to be parted. I think separated. It was good for the growth of both. And then the question was, who does voice belong with and who does electronic belong with? And voice naturally, it's an industry that needed consolidation. There was industry pressure from regulation, from competition, from electronic platforms and so forth. And traditional customers shrinking. And there was a natural consolidation play where you bring together, 5 had to become 3 in an industry. There's also lots of boutiques. So that was always the first transaction that had to happen to leave us with the electronic and digital assets. And then CME came around and offered us a good price. So,
which sort of brings us on to Galytix now. Tell us a little bit about that.
Well, one of the things that interests me about Galytix is really where we are on the digital transformation journey. Digital transformation's a dirty word that all the consultants love using at the moment, and it's all the marketing.
But it's a real thing, right?
But it's a real thing, and banks and financial institutions spend more on IT than anyone else. The budgets keep going up every year. They always say it's changed the bank and innovation, but actually most of it's run the bank. It's it's technology from the last century in most cases. Galytix, we're 130 employees, mostly software engineers and data scientists and data engineers, all cloud-based, really scalable technology. And that we're very focused on 2 use cases in particular, the corporate banking market and the insurance market. And if you think back at the discussion we've been having about, I guess, digital, technology being adopted in the capital markets, having seen how it's evolved in capital markets and had the maturity, I thought corporate banking and insurance were 2 sectors looking for it. Definitely. And why? What do we do? Well, we reduce costs and we reduce risks. In corporate banking, our clients tend to be systemically important banks. We digitize their whole corporate banking credit risk process, all the way from data discovery to ingestion to transformation to analytics. We recently wrote a report about this on early warning signals and so forth.
Definitely worth reaching out. Speaking of this, I mean, I've looked at it and I've seen the sort of hype videos and all that sort of stuff you've done, which is great. Tell us a little bit, or tell people where they can get. I know you work with PwC on putting it all together. It's got some really good details on it. Where do people get their hands on this?
Yeah, so if you want a hard copy, email me or DM me. I'm old school. I like a hard copy, or you can get a copy from our website.
It's good to see hard copies as well. I
I'm enjoying in-person meetings and I'm enjoying hard copies
Quite
again
right,
after this COVID world we live in. The great thing was working with PwC. We have a global strategic partnership there. Worked very closely with the UK and Luxembourg banking partners and financial services partners on this report. And the thinking was really, the credit cycle is turning. I remember when I joined Galytix last summer and I talked about the credit digitization model, how we take hundreds of data sources from annual reports of companies to news flow and sentiment analysis to court documents, and we digitize the ingestion of that with our algorithms and reduce the manual processes. Everyone got that. Then I talked about analytics and how you can use all these data sources to really improve on rating agencies. If you look at most of the indicators of credit default at the moment, they're pretty late indicators. When S&P and Moody's downgrade Wirecard, it's typically too late, we know. And we've seen this movie play out over and over again, whether it's Wirecard or Carillion in the UK services sector, where credit analytics have been late. We find that banks and insurers have different kind of analytical requirements around climate change and so forth, and cat risk. We find that they want something bespoke built for them. So they'll take our indicators, and we have a framework, we call it the LEGO framework. L for leverage, E for external factors, indicators, G for governance, and O for ontology. Ontology is essentially how you bring together everything. I
was wondering where that was. But I'm pleased you brought that to life for me.
It's a la bricks, the bricks analogy. And the key thing is that that's a very, very scalable model we have, but we'll tailor it for the bank or insurance company because they have the indicators they want to look at. They also have proprietary data. Some have great internal data from their transaction banking network. It's not just information from someone who borrows from you, but if you do if the borrower does all their payments, paying payments to suppliers, payments to customers through you, you have a different kind of granularity to that. But overall, I think one of the things that was really interesting for me about Galytix is where we are in digital transformation in those use cases. So if you think about where capital markets are, think about the trading floor and where the trading floor is. You think about user interfaces in retail banking. There's a lot of money going into those areas. There's a lot of investment and a lot of changes happened in those areas. Whereas corporate banking, credit risk, and insurance still has a lot of manual processes. They need to automate those, and they need to have new signals for a new world, whether that's credit defaults that are rising with the credit cycle, or ESG. You need all this new data from ESG, and we're getting banks call us every day say, well, it's not just about an ESG formula or these are the ESG metrics that matter. It's like, how do you bring that together in a systematic format? And it's a combination of humans plus algos.
It's that next generation, really, isn't it, of digital transformation within the banking sector? It's looking at where I'm always fascinated about where opportunities are for innovation and what's ripe for disruption and what's ripe for modernisation. I think what you're talking about there is two sectors that have probably fallen, or two areas that have probably fallen behind a little bit. Need to be shaken into the next level.
And obviously, people talk about mega trends in the market and mega trends, and obviously digital transformation is a mega trend. The other two mega trends are really risk. We've had a 40-year risk-on world of low rates and free money. And I think, when I took this job, I think last summer I was talking to a friend of mine who's the head of markets in one of the big banks, and he's like, I completely get it. I completely get corporate banking and insurance and how it's different to the trading floor that you described. But he's like, no one ever defaults. And that was last summer. And now we're in a different world where, risk managers...
So this comes back to that lucky or genius, basically.
Lucky or genius thing. And hopefully our report is timely. It's a combination of both, in the sense that you have to build these things early. We discussed it earlier in the call. You can't build a cutting-edge early warning system. You're looking at, hundreds of data sources and, the day Russian tanks go into the Ukraine. You have to build it over time. And we're finding that that's a real catalyst, rising risk, and that's risk around credit default, A, B, ESG, which is a different kind of risk, and C, things like climate change and so forth, from a loss ratio at insurance companies and so forth. Something I wrote about recently in the Financial Times is the sort of story of Abraham Wald. Abraham Wald was this Hungarian mathematician in World War II, and the story was essentially around planes coming back from World War II, from the battlefield.
I love this story.
And obviously all risk managers, they look at these planes, they come back, and the planes, where you have bullet holes in the plane, that's where you need to reinforce it. That's where you get pay consultants tens of millions of dollars, or you have this massive risk transformation program. But you also have to look at where are there no bullet holes,
Yeah.
because those are the planes that didn't come back from war.
Exactly right. Yeah.
And you know,
I love. I'm always fascinated by that story. It makes perfect.
I have to say that's not my story, and I found it on Twitter because everyone keeps banging on about it on Twitter and so forth. But you know, one of the key things was really, you know, what we grew up in trading. You know, past performance is no indicator of future performance.
Yeah.
You know, the causation versus correlation debate that you know I used to have on the desk, you know, in the old manual world is so relevant in the data science world.
Yeah.
You know, you could have lots and lots of data and lots of correlation, but
it's amazing how that sort of worlds have now moved into it. You know, again, it's that sort of natural sort of cycle to what was relevant to you in the past and how that moves into data, which I think is the most fascinating, you know, space full stop at the moment.
Yeah.
And I think there's so much more that can be done. I talk about this on the show all the time about how financial services can utilize data so much better.
Yeah.
And create a much better system and much more efficiency, productivity. Every single aspect of the business can be changed by it. And I guess that's where the business is set now, right?
Yeah, completely. And it's sort of data means the business. I think the business needs to lead. You know, IT can't be an island.
Yeah.
You know, I think there was a nice piece in the journal about this last year where a professor wrote about IT being an island. And IT can't be an island. There has to be a use case for everything. And, you know, understanding the pain points, the business's pain points. And that's why I think, you know, our lane, if I think about it, you've got data vendors on one side, you know, the big Bloombergs of the world and so forth. They mutualize your data. You know, the data you get in your Bloomberg screen, someone else has that.
Yeah.
They're not going to build you something bespoke.
Yeah.
They're not using your indicators and so forth. They're not going to go the same granularity of thousands of pages of annual reports.
Mm-hmm.
On the other side, you've got tech vendors, you know, Microsoft and the big tech guys. And just as you don't get fired for hiring McKinsey in the strat world, you don't get fired for hiring Microsoft and Google in the IT world.
Yeah.
But, you know, and they have amazing AI capabilities and so forth. But, you know, do they bring the depth of domain expertise around?
Personalization, isn't
exactly.
it? That's what people are looking for at the moment. I think if you look at everything that's happening about companies collaborating together and interoperability and everything around that, it's all based down to what I think is digital natives now looking for hyper personalization and what they're looking for.
Yeah.
And that seems where you're
definitely. And I think that domain expertise around the industry knowledge, whether it's understanding what early warning signals to look at, because, you know, that experience can help data science a lot and can help data engineering a lot. And I think that domain, bringing that business domain expertise together with the technology and the data science, I think is really, really crucial. Just as it's very important to bring the AI together with the humans. Yeah. You know, it's not about, you know, AI replacing. You know, we call it human supervised algos.
Yeah.
And, you know, recently I was giving testimony to the US Chamber of Commerce on AI for Galytix, and we had a great day. And I saw a lot of other presenters, and we discussed explainability and AI ethics and all the things that we talked about for the last 2 years. And many of these conference panels, we discussed these things. But actually bringing man and machine, or humans and machines together, I think is the really important thing.
Yeah. And
having a human in the loop. And where do you have a human in the loop? And the human needs to be in the loop on the data engineering side to make sure quality assurance is high. Yeah. But then also on the industry expertise side, because
and the interpretation of where it is, isn't it? You've got there's data visualization and there's storytelling as well, isn't it?
Exactly, because you know that data, it may look great, but I think there's a great cartoon about it. You know, the correlation of of XYZ, it correlated for the last 20 years.
Yeah.
So as a result, this is the model predicts.
Yeah.
But was that correlation, or was that causation, or how's the world changed? And those indicators that we looked at for the last 5 years, are they still relevant?
Yeah.
You know, how do we fine tune them every day? And then AI and algorithms. The biggest thing for me is not that AI is evil or good or bad. It's really model relevance. And the work I did at the Financial Standards Board with a lot of the heads of trading at banks, that was the one thing that came up.
Yeah.
Are general AI risks relevant for algo AI risks on the trading floor of banks and asset managers?
Yeah.
And in a similar way, if I look at what we do in terms of the digitizing of documents, we need to get, the advantage the algorithms have is they can scale, they can do it at scale and speed. They can go thousands of PDFs, thousands of documents, and they can algorithmically do that.
Yeah.
But the advantage humans have is humans are pretty accurate at that.
Yeah.
So you need to have the scale and speed of the algo, but you also need to have the human accuracy.
Exactly right.
The flip side is, I was talking to a friend of mine who runs a big hedge fund about this the other day. If you're a hedge fund manager, you don't need to have 100% accuracy. You need to just be better than the other hedge fund manager, which could be 55% of the time.
Yeah. So I think there's some really interesting things that are happening at the moment in the marketplace, and I think there's loads of innovation that still can be achieved, and that sort of humans and machine element is, to me, where the next frontier, that next future of this industry heads, and there's so many benefits to it. We're also seeing quite a lot of headwinds. We're seeing a lot of macroeconomic noise at the moment, pointing towards recession, pointing towards tough times to come. Everything is burning at the moment. When we look on the side, that has knock-on effects to the VC world, to the investor world, everywhere in between. I personally think there's an awful lot of opportunity in that, and I'm seeing it on a daily basis. Tell me what it means for you and the team.
Yeah, I mean, from a product perspective, actually, everything going on is good. People need our products. People need an early warning signal product when credit risk rises. Banks need to reduce cost. One of our biggest bank clients said to me the other day, by automating a lot of manual processes for them in credit risk, they've reduced costs by 30 to 40%. They've increased the speed of action, the time to market to take credit decisions by 30%. Well, that really matters, both the cost element and the risk element in this market, because people are under pressure to drive that change, and so as a result, in some ways, this is good for us. In terms of,
it's always difficult to say that, isn't it? I remember talking to companies during the pandemic, the start of the pandemic, and it was like, this is it creates volatility, and when there's volatility, there's opportunity. It always has been, and I think you're always sort of reticent to say that the recession helps the business, but what you see is companies there who are set up to help businesses through it become really important. And I think you guys are really well placed for that. Right?
I mean, I think it also goes back to the kind of clients we're looking for and the kind of shareholders we're looking for.
Tell us about who you are looking for.
So we're an enterprise software B2B clients. Our clients are typically large banks and insurance clients. We're looking for strategic partnerships. So we're not looking for hundreds of clients. We're looking for clients that we can have deep relationships with. We go in for a couple of months to prove our technology and work with them. And where the relationship really works for us is if it scales. These are enterprise-wide deals where we're working top of shop with the C-suite of the firm in their risk engine and so forth. And as a result, the sales cycle is long, and we're not looking for lots and lots of small relationships. We're looking for meaningful strategic partnerships. Those things take time anyway. They want to speak to your other clients. They want to understand your product. They want to test your technology and so forth. So those are not 2-month, 3-month sales cycles. They are longer sales cycles than that. In some ways, much more than a typical B2B enterprise software product. And we always have a balance between standardization and building something for the customer. So the algorithms are standardized, the data engineering process is standardized, and so forth. But then each customer will have something they'll want different. So the kitchen, we always say internally, or with clients, it's the same kitchen, but and the same, but we change the recipe slightly. Because that client wants to have a proprietary edge over another client, and that takes a little bit of time. So it's a different kind of sales cycle, a different kind of client. And then going on to our shareholders, we're enterprise software B2B. We are, and we're interested in, we've got a very sophisticated shareholder base, and the nature of the company. One of the things that attracted me was the founders have built this company. They bootstrapped it for many years, and then they're very, very thoughtful about which shareholder that they get on board. It's not about money. It's really about getting the quality shareholders who can join the board or have an advisory relationship with us, who can. They may open doors. That's great to potential clients, but can give us advice on strategy, on portfolios, and so forth. So it's not just chasing the fast money.
Absolutely, I think that's so important as well. I think it's really underestimated, people choosing who they partner with in that sort of instance.
And I think the institutional market is has grown a lot, and it's very sophisticated and provides a lot of that. But it's really finding the right institutional investors, the partners that have really understand B2B and enterprise software. Because it's really different, because everyone says they do, but it's very different to a social media app like I've got 50,000 Kendall Jenner followers, 50 million Kendall Jenner followers, and so forth. And how do you scale that? It's a really, really different business model. It's a different sales cycle. Whatever the metrics you look at around customer acquisition and so forth are very, very different. So it's not just about chasing money, and I see it in every day, and you see these press headlines: unicorn born, $1 billion fundraise, and I'm like, well, it's actually not a unicorn; it's a fake unicorn, because whoever's joined that Series E has preemption rights against anti-dilution.
Yeah.
But it's one of those clickbait headlines. It gets everyone excited.
Everyone likes it.
And a lot of founders like that. Oh well, I'm running a unicorn. The other guy runs a unicorn.
Yeah.
But actually,
it's moving through the vanity, isn't it?
It's moving through the vanity, and how much money do you need to move the full business forward is the key question.
Yeah.
And who do you need?
And how are they going to take that further forward with you as well?
Exactly.
Yeah. So we know who you can help. We know who you want to speak to.
Yeah.
Tell us how they should get in touch with you.
Well, you can get in touch with me on LinkedIn. You can get in touch with me by email. My full name, rupak.ghose@galytix.com, or any of the rest of the management team. We're always looking to speak to people in the market.
It's an active team, and it's a great business. You're doing fantastic things at the moment.
Yeah, so
I'm really excited about.
We're going global. We were 12, 15 people 2-3 years ago. We're 140 people.
It's amazing.
We were one location. Now we're 5 locations. We're London headquarters, but we've got a big office in New Delhi in India, big office in Prague in the Czech Republic, a big Zurich office, and then we're just about to open a Luxembourg office as well.
Incredibly exciting. You look like you're enjoying it.
I am indeed. I'm enjoying getting out to meet people and give people hard copies.
I love it. I love it. I love meeting you in the flesh. I love the hard copy. And it's been great having you on the show.
All right. Thank you, Toby.
Thanks so much for coming on.
Thank you for your time.
And thank you all for watching. We will see you soon on another episode of FinTech Focus TV. Thanks a lot.